good morning. I'm Pete Seyler, and this is Markets in a Minute for the week of July 20th. Markets this week were driven by a mix of economic data, start of earnings season, global developments, and Kevin Warsh's testimony before Congress. First, on the earnings front, the quarter kicked off with bank earnings and several major players reporting. JPMorgan, Citigroup, Wells Fargo, Goldman, and Morgan Stanley generally posted solid results with strong trading activity, investment banking, and healthy credit conditions as the drivers. With capital markets booming, this has been the primary backdrop behind earnings growth, as M&A activity, equity underwriting, and trading revenue all surged. Of note, Jamie Dimon characterized the current environment as close to as good as it gets. To us, that raises an important question. If earnings and stock prices need to continue improving to support further gains, where does that catalyst come from if Jamie is right? On the economic front, CPI and PPI were released midweek. Both headline and core measures were cooler than expected, with PPI reinforcing the idea that cost pressures are easing. This gives the Fed some room to maintain patience on rates, assuming oil prices do not spike again following renewed tensions between the U.S. and Iran and the potential impact on the Strait of Hormuz. Receiving much less attention, but arguably just as important, was Fed Chair Kevin Warsh's first semi-annual monetary policy testimony. A few key takeaways stood out. First, Warsh reinforced a disciplined, data-dependent approach to monetary policy. He emphasized the Federal Reserve has no tolerance for persistently elevated inflation and reaffirmed the Fed's commitment to its 2% inflation target. This is important. Second, he was critical of the Fed's 2020 monetary policy framework, arguing that it ultimately failed to achieve its intended objectives. Specifically, he pointed in the direction to allow inflation to run above the Fed's 2% target in an effort to support a broader labor market recovery. In our view, this is important because it suggests Warsh may be less willing to tolerate above-target inflation in the current environment, as many presumed he would be using any excuse to cut rates. By signaling a willingness to remain tough on inflation, jawboning if you will, the Fed can influence expectations and potentially avoid having to take action later. This was an overlooked but important takeaway from this testimony. That's it for this week. Looking ahead, all eyes will remain on whether the U.S. and Iran return to the negotiating table and what happens with oil prices. We'll also continue to watch earnings, with Alphabet and Tesla among the headliners. Have a great week, everyone, and I'll see you next Monday.